A report by Bloomberg titled Wall Street Snubs China for India in a Historic Market Shift calls for a deeper understanding of what makes India attractive. Let's go one by one. First, Marshall Wace, Wantable Holding, and Janice Henderson are focusing on India, rather shifting their focus from China to India. Why is this important, you ask? It's because they're the world's top financial institutions that hold the power of impacting markets and sentiment. Their priority in India cannot be simply ignored, especially when investors are now pulling out of China from a country that has been an attractive investment bet for almost 2 decades. America's Morgan Stanley, Goldman Sachs, and Japan's conservative investors, known for their cautious investment strategies, seem to muster significant and calculated confidence in India's growth story. But is India, being the fastest growing emerging market, the only reason? Well, while the bullish sentiment isn't new, the resemblance of the countries to China at one point, and therefore its potential replacement, is fanning the flame. The country's population is still largely poor, stock markets are expensive, and bond markets insular. But most are making the crossover anyway, calculating that the risks of betting against India are greater. Moreover, according to the Bloomberg report, history shows that India's economic growth and the value of its stock market are closely linked. If the nation continues to expand at 7%, the market size can be expected to grow on an average by at least that rate. Over the past 2 decades, gross domestic product and market capitalization rose in tandem from $500 billion to $3.5 trillion. That is a whopping 600% increase in 2 decades. Let's look at some more factors. It's not just Morgan Stanley or Goldman Sachs, but as I mentioned earlier, Japan's retail investors, who have traditionally favored the US, are also warming up to the country. 5 of their India-focused mutual funds now feature among the top 20 by inflows. In fact, Nomura Indian Stock Fund is at a 4-year high. Talks about India rising as a manufacturing alternative to China has been loud and clear for a while now, especially after the quiver in sentiment of global investors and businesses towards China post the pandemic. The Bloomberg report said if China is viewed as a threat to the Western global order, India is regarded as a potential counterweight. And just to put into perspective, India's Nifty 50 recorded returns of 23% in the last 12 months against a drop of 19% of China's Shanghai Shenzhen CSI 300. PM Modi plans to sell India as the world's new growth engine. And on those lines, Finance Minister Nirmala Sitharaman announced in her interim budget that infrastructure spending will be increased by 11% to 11.1 trillion rupees in the coming fiscal year. But is India expensive? With attention comes price, and India is no different. The euphoria has made Indian equities among the most expensive in the world. S&P BSE Sensex Index has almost tripled from its March 2020 low, but earnings have only about doubled. In fact, according to data compiled by Bloomberg, global funds took out more than $3.1 billion from local shares in January, the largest monthly total in a year. India fans say that they're investing for the long term, adding that with a still low per capita income, the country is setting the stage for multi-year expansion and new market opportunities. India is also trying to globalize the rupee, although at a more modest scale than China's yuan expansion. The confidence in India seems to stem from the long-term impact of multiple initiatives and not necessarily from the near-term outlook on the nation's stocks and bonds.